LIC Housing Finance, HDFC, Repco, Home First, Aavas. Which stock will offer the best value? With disbursement bouncing back to pre-COVID levels, housing finance companies saw a smart bounce back in the quarter ended December. The IL&FS default, subsequent economic slowdown, had negatively impacted the vertical, with the total housing loan outstanding declining in FY19 and FY20. The COVID-19 pandemic further intensified the issues that were already being faced by the sector. But now, the sector has seen a turnaround. Housing demand has seen a revival aided by discounts from developers, stamp duty cuts, and lower interest rates. Collection efficiency in retail housing loan segment is now at pre-COVID levels, and asset quality is holding up better than feared at the outset of the pandemic. Housing finance market with loan outstanding of over 20 trillion rupees in FY20 grew by around 16% from FY15 to FY20. CRISIL expects total housing loan outstanding to grow at a CAGR of 8% to 9% over next 2 years. What more? Profitability is likely to improve on lower provisioning in FY22. The affordable housing finance, property price usually lesser than Rs 15 to 20 lakh, has done remarkably well. As per the latest ICRA report, the total portfolio of the new HFCs in the affordable housing space stood at 55,061 crore rupees as on September 30th, 2020. And registered a moderate growth of 9% year-on-year compared to sector's overall negative growth till December end. Now let's talk about segment consolidation, performance and asset quality. Following Dewan Housing's closure, with Indiabulls Housing and PNB Housing witnessing decline market share, the sector is going through a consolidation phase, with HDFC and LIC Housing Finance being the biggest beneficiaries of the ongoing consolidation. For HDFC and LIC, the net interest margin stood at 3.4% and 2.4% for Q3 FY21, same on a year-on-year basis. HDFC saw its loan asset base expand by 10% on a year-on-year basis, while for LIC it increased by 6%. But HDFC saw its profit after tax dwindle by 65% on year-on-year basis. The smaller HFCs, especially in affordable housing, has higher margins due to exposure to relatively riskier self-employed group. Repco saw significant margin expansion in Q3 on reduction in cost of funds. On the asset quality front, the moratorium and the Supreme Court's stay masked the reported numbers of Stage 3 assets or gross non-performing assets ratio, though at the same time, pro forma GNPA ratio without the Apex Court's dispensation wasn't much higher to reported numbers. Provision coverage has been healthy as most HFCs has created additional provisions. Asset quality also depends on its customer mix. Cash flows in self-employed segment are highly vulnerable to adverse economic cycles and adds asset quality risks. Any tightening in liquidity and or slower economic growth could impact the asset quality in segments such as construction finance and loan against portfolio. Valuation. HFCs differ in valuation and there's no uniform picture. While LIC Housing Finance is trading at a discount of over 60% to the market leader HDFC, Aavas, the number 3 in the space, is trading 8 times that of Repco, whose valuation remains attractive. HDFC's valuation is also offering little upside, as it is 3 times that of LIC Housing Finance. So is the worst over, and is it the perfect time to scale new heights? Not likely. HFCs are losing market share to banks as they have increased focused in the segment amid the muted corporate credit demand. Banks have advantage on pricing due to low cost of funds, making it difficult for HFCs to compete with them. For instance, SBI is offering home loans with interest starting as low as 6.80% per annum, which is lower than cost of funds of smaller HFCs, whereas Repco Home Finance's cost of funds in quarter ended December 20 stood at 7.9%. But overall investors can pick up HFCs like LIC and Repco Home Finance as the risk reward is extremely favorable.